My name is Ash Nababi. I'm an economist with UrbanToronto.ca. Today we'll be talking about development applications, how they work, and what the statistics are when it comes to the development applications to the City of Toronto in the last year compared to the previous year. With me are my panelists today. We have Maurice, he's from Fora Developments, and we have Jeff from Castle Point Numa. After I'll be giving a brief 10-minute presentation, they'll each be taking turns to talk about their companies and their projects that they've been working on, and then we'll have I'll ask them a few questions, and then we'll open up to the rest of the room for you guys to do a Q&A. Okay. So what happened to Toronto applications in the year 2022? So before I get into that, I'll just tell you some background about Urban Toronto. We are a website. We follow news in the development industry like no one else. We've been in business for 20 years. We started off as a forum, and from a forum we started building a news website, and then from our news and forum needs, each thread, for example, the one, has hundreds or thousands of pages of comments and pictures, etc. There was a need to find or to centralize the information when it comes to a project, so people aren't going back to page 14 to find this information, 325 to find that information. So we started building out a database for each project, and then from the database, the small database, it started to grow and grow. We're now covering basically every municipality in the GTA, including Hamilton, some in Niagara Falls, and Cambridge, Kitchener, Waterloo, all the way to Oshawa and Barrie to the north. Our forum has 10,000 plus members, and we, again, cover everything in the industry regarding news, trends, and events. So UT Pro is our premium database service. So we have a lot of information that's available for free on our website already. If you go to UrbanToronto.ca, you'll see a button that says database. You'll see we have both a project database and a company database. The company database is basically an online portfolio for our member clients. And for the project database, we have every project that I was mentioning. We also have a map that maps out all the projects. But for the free database, you get some basic information about heights, units, and who the developer and architects are. Our premium stuff gives you every piece of information we have, which is lots. And you'll see it from here. So in 2022, we had 293 applications for new developments in the City of Toronto. And a new development, we're counting anything larger than a monster home or a semi-detached or something like that. So basically, townhouse and up, but we're also including subdivisions. So if there was a large plot of land subdivided into detached homes, we would count that as well. But most of these are obviously are condos and skyscrapers, etc. Here's the month-by-month breakdown in terms of applications in 2022. And here is so you'll notice that there was a spike around March and April. We can talk about that later. But here's the category that the developments had. The biggest one was mixed use. Mostly there was a residential and a retail components. That's classic condo buildings. And then we had 30% that were residential only, 4% that were commercial only, 5% that were institutional only, and then 0 that were public space or public parks, and then 1% that were transit stations. Here's another way of breaking down that information. So we had, out of the 293 projects, 153 of them had a condo component, and another 153 had a retail component, so almost 1-to-1. There were very few offices proposed, only 45 out of the 293 applications, and 94 had some sort of rental components. And rental we break down into market rate rental and affordable rental. Affordable rental also includes replacement rental. So if there was a project that took over some existing rental project and they only kept the 8 or 10 or 12 units that were rentals, that would count actually as a rental unit. So this is a slight a slight overestimate of the pure new rentals that are being developed in the city. We track parking information. We break it down by bicycle and vehicular parking. You'll notice that for this year we had more bicycle parking proposed than vehicular parking. This is the first time actually that this has happened because the City of Toronto basically got rid of the minimum parking requirement, vehicular parking requirements. So we had a lot of projects that were proposed with very little vehicular parking and lots of bike parking instead. Let's compare 2022 to 2021 now. So 2022, 293 projects, much less than the 317 projects compared to 2021. The GFA in square feet proposed in 2022 is also less, about 15% less, 89 million square feet to 111 million square feet in 2021. The GFA proposed per project is also down, so not only did we have fewer projects in 2022, they were smaller as well. That's about 350,000 square feet proposed per project in 2021 versus 306,000 in 22. So the number of units proposed in total, 125,000 in 2021 versus 101 in 22. And the unit mix, however, was more or less the same. So we didn't see a large increase in 3+ bedroom units, which is what the city wants in terms of building for families, et cetera. And you'll know that there is a new bylaw that developments have to have, certain large developments have to have 10% minimum 3+ bedroom units. And that since we're at basically 11%, we're very close to the minimum threshold. Just to summarize some of the databases that we offer at Urban Toronto, we have the project database, the company database, again, which is a portfolio of sorts, and we have the map. We also have some subscription services. The New Development Insider is a daily newspaper that goes out every morning that tracks all the new development going applications, as well as the updated applications, as well as information from the OLT, events that are happening, et cetera, that goes out every morning. UT Pro is our premium subscription service, and the Instant Reports, if you just want to know some information about a specific part of town, so you have an address, you want to know what's within 800 meters of that address, or there's a MLS zone, or you have a ward in mind, you can get a quick and instant report based on that as well. So with that out of the way, it's on to the main event, and we will start with Jeff Brenner introducing himself and Castle Point Numa.
Hey everyone, so Jeff Brenner, partner at Castle Point Numa. We're a full cycle real estate development shop. We've been around for 30 years. Currently we have about 8 million square feet in active development, primarily concentrated in 3 areas, so the waterfront and the Portlands, Lower Junction, and Weston Lawrence. I think what makes us unique is our timelines and time horizons. So we like going in early to an area and really being the agents of change in an area that we think we can transition. And historically, we've done primarily high-rise condo and industrial, and more in our portfolio, we're looking to retain long-term rental assets in terms of residential. This is a good example. So this is a project at Weston and Lawrence. Weston Lawrence has all the kind of key elements that we look for. So we've been there for several years now. Although we weren't the first, really Rockport was the first to deliver a building there. It was a rental building that's since been purchased by Dream. But Weston and Lawrence, that corner, that retail, in a lot of measures has been in decline for the last 20 to 30 years. However, the introduction of the UP Express and GO transit station there, delivers a ton of potential. There's also some really interesting natural elements with, you're on the ravine, the Humber River, the parkland. There's some really great single-family neighborhoods north and south of there, but really that kind of retail strip has been challenged. So we like to go into those projects because we will take a long-term view and see how we can kind of go and be agents of change there. I would consider these pretty slam dunk applications in terms of we're on top of a major transit station, in terms of the height and the density and the use, although we still expect probably kind of 24 to 36 months to go and get the approvals here. This is, we call it BB2. Quadrangle's the architect. We focus a lot on the ground floor activity. That's obviously what people interact with a lot. So we're a lot of our buildings now, we're looking at brick facades, really creating some compelling, smaller retail units, especially in this area. If you go to the next one, again, I really like the design on these buildings. This is kind of neat because they back on to the ravine, they overlook the ravine, so we've tried to have this kind of dual component to both of these projects. It's an interesting thing, and I'd say one of the challenges we face right now is doing what's, we think, right long-term for delivering housing versus what makes the numbers work today, both for rental and condo. So, example of that would be balconies. If I could, I would say we would do no balconies in any of our buildings. I think they look better, they're more functional, but it's just a reality of the current kind of market where, investors and the brokers and the sales and marketing people will say, you need to have a balcony. So this one's kind of neat because it's maybe hard to see, but I guess you could call it a micro balcony. It's probably like a meter by a meter to kind of give that fresh air ability. But, having lived in condos, I don't know, I maybe go out there once or twice a year, realistically. So same sort of thing with like unit sizes. These are things where there's a lot of attention spent on what's the right size. There's a huge trend towards smaller units, smaller living spaces, because it's really tough to make numbers work, whether it's on condo or rental, regardless of your price of entry. Costs escalation, fees escalation. So, most projects you see now, it's a pretty small unit size. But I do think long term, when you look at some more mature markets, whether it's a market like New York, there starts to be a premium because you start having families and couples and more people living in condos. So a bigger unit actually comes at a premium. Or in places in the U.S., it's more common to have a roommate, so you want some more size, you want more bathrooms. But for the current market, we're really trying to put a lot in very small spaces. We now use this term urban bathroom, which is, I'll let you imply what that means. So those are some of the things that we're challenged with on, again, we would love to do bigger unit sizes, maybe not do as many balconies, do some more amenities, but that's kind of just the reality. Anyways, these are two of the kind of more recent applications. We put these in, one in December, one in January. So I guess we'll see if some of the initiatives to speed up approvals have happened. We have another site just across the street on top of the GO station. It's another 2-tower site. So anything we do also, we try and get a critical mass. So we try and hit at least 1 million square feet. At this corner, we're at about 1.5 million, just in terms of how we go about it.
Great, thank you. And just for the audience here, if anybody is interested, you can talk to me afterwards. I will be sending you the slides. I saw some people taking pictures. So next up is Maurice from Forward Developments. Take it away.
Good morning. So Fora is about a year old, which is, I think, a big change and a big differentiator between ourselves and a lot of our peers. A lot of our peers have been around for decades and in many cases generations. I myself came from that world, and I'm in startup mode. A bit of my background, I studied architecture and urban planning, and I had to put myself through school by working on a construction site. So I really was doing all of that simultaneously, boots on the ground, starting to get to know what site safety must look like, doing concrete takeoffs, rebar orders, and making sure everybody had toilets. And as I was finishing my first project, sort of rising through the ranks on a construction site, I then went into project management and asset management simultaneously, and worked for a company called Shiplake that was intent on building purpose-built rentals. We were some of the earlier developers, builders of the new purpose-built rental wave in the last, I'll call it 15 years. build a few thousand units that are still under ownership and management of Shiplik. And just by being in the industry, I started getting a lot more opportunities coming our way, and I saw that really the only way to be competitive in the commercial land market was to consider condo tenure as well. So after about a decade of being with Shiplik, I left and I started a company called Collective. Collective was founded about 7 years ago. I was the founder and president there for the first 5.5 years. We did amazing things in a very short period of time, and it was a partnership that came to an end because of my choice, and I've started yet again. So I'm in startup mode second time around, and we've done some fun things in the last year. 15 and 17 Elm is one of our recent applications. So Elm Street is in the Yonge and Dundas neighborhood, and I mean, I think it's a striking piece of architecture. A lot of people have been paying attention to what we submitted here because it is just a like a building that looks nothing like anything else in the city. We worked with Partisans Architecture to design something that's been called Gaudi-esque, and you know, we're still doing a lot of the detail design to work out what exactly the facade paneling could be. In its original intention, I guess it was a precast building, so precast concrete panels being hung from the facade. But we've started to look at some of the more, I'll say, some of the newer technologies and going outside of the Toronto manufacturing market in places like elsewhere in North America, or even some Dutch company that's quoted aluminum panels, or GFRC, so a glass reinforced concrete panel. And so when you have glass reinforced concrete, you go from having a 6 to 8 inch wide precast concrete panel to something that's between 2 and 3 inches. And so that diminishes the weight tremendously. It diminishes the weight on the structure, so the building bones can change significantly as well. And when you go on Urban Toronto's forum, you know, some of the conversations are, well, will this ever actually get built? And it's a great question, because it is daring to make an application where my construction cost, I know going into it, are considerably higher than what the market can command. And so it begs the question, two questions, I guess. One, can I command higher revenues? And the assumption is no. And two, so where is the offset? Because at the end of the day, in order for me to get construction financing, I have to have a margin, right? We're talking about cost escalation, you know, and revenue escalation, and they sort of go like this. The margin always stays the same. Sometimes it squeezes, sometimes, you know, you do a little bit better. This is a site that was offered to me week one of being in business at Fora. And we were able to do a deal for incredibly advantageous land cost. And so, you know, the decision was, instead of lining our pockets with a little bit more dough, let's reinvest it back into the building. So that's been the decision here. On Elm Street, we have buildings surrounding us on the north side that are in the 70 or so story realm. Here we've applied for a 30-story tower, and we are capped in metric height, roughly 100 meters, by the Sick Kids air ambulance flight path. So that's what's indicated the height for us here. That's one thing that you can't really get around and will never really be changed. Yeah, we're still sorting out lots of movement with the city. We're before the Heritage Preservation Board Monday morning. because there's what I call a, well, forget what I call it. There's an existing building at 15 Elm, which the Preservation Board is looking to deem as a heritage piece. It has no attributes whatsoever, in my very subjective opinion. And I think that what we're trying to do here really is, architecturally speaking, a lot more significant for what Toronto, needs today. I think this type of investment is a unique opportunity for us, and we took it. Another one of our sites is 2440 Dundas Street West. This is Dundas, just north of Bloor. It's sort of the junction meets Romsey meets High Park. Also an Up Express stop. So you have the Up Express at Pearson and at Union, and in between it's here. So actually within the boundary of our site, a little corner of it is being expropriated by Metrolinx for the pedestrian and vehicular drop-off at the Kiss and Ride for the Up Express and for the Bloor Go as well. And obviously, being within 100 meters of Bloor Street, we have the Bloor subway line as well. So a phenomenal transit site. Currently on the site, we have a Sobeys Freshco branded 18,000 square foot store and a Shoppers Drug Mart on opposite ends of the site, and a big parking lot in between. Very suburban model in a very urban area. And we're looking at certainly doing some interesting design with lots of color. I usually am afraid of color, but Ralph Janona here, the architect, put something very compelling, and we went with it. We're also adding along the street frontage, kind of hard to see on this rendering, about 1,000 square meter park. Whether it will be dedicated as a city park or privately owned but publicly accessible space is to be determined through the planning process. We're replacing the grocery store and the existing commercial space at a 1-to-1 ratio. So there's the Shoppers and the second floor above the Shoppers where my office is. We're looking at condo versus rental. And just as we were walking over here, Jeff and I were talking about, really the inability to plan ahead, even just a couple or few years, and make the decision that this will be a rental tenure building for us. My partners on the site have owned the site for about 25 years, so their cost base is quite low. The land value through the rezoning process will have a considerable value increase. And even still, does it make sense for them to keep that value in a rental building or not? And that will be a function of where rates go, interest rates, rental rates, construction costs, and a lot of the elements that are baked into the final approval that will determine, the total development cost for our project. We'd love to see some mixed tenure here. Over the last 15 years, I've built about 4 million square feet of mixed-use density, and half of it has been purpose-built rental, and the other half has been condo. And we have another 3.5 or so million square feet in our pipeline today. In a year, we've built a significant pipeline. A lot of it really is just getting the approvals for mixed-use housing, independent of whether we're going to take it to market for end users to be owners or investors, or for larger, sort of rental property stuff.
So for both of you, interest rates have been a big news story for this year. And in my opinion, as an economist, that's probably a big reason why we've seen a reduction in applications for the first time in who knows how long in Toronto. So in your personal businesses, how has interest rates affected timing, if it has at all, and other than interest rates, what else are the big major impact factors when it comes to making a timing decision?
For me, it has had no effect. And I say that because, again, Fora being a brand new company, all of our sites being brand new sites that we're putting into the development pipeline, a project like this is 8 to 10 years. So really, I would say it has no impact on interest. Interest rates have no impact on our decision to move forward with an application, but that's certainly different if you're bringing a project to market for pre-construction sales. I think the biggest challenge with interest rates, in my mind, is that consumer confidence is down. It's not that interest rates have taken the development industry out of equilibrium. I wouldn't say that. I just think consumer confidence is down, and a lot of people are waiting and seeing, and will make moves once there's a little bit more, again, confidence in the market.
Jeff?
Well, similarly, a lot of our sites are on longer-term timelines, especially stuff at the waterfront. But I actually think for us, it does have an impact, mainly on financing, right? So land loans, we're doing, because we have pretty long horizons, we've continued to acquire and invest in new land. Hard to find land financing these days, so I think you're seeing a lot of any acquisitions that are happening, at least what we're seeing, is heavily structured. So whether it's vendor financing through a vendor take-back mortgage or delayed closes. So I think that's had an impact, mainly from the banks and institutions really going pens down. In terms of our sites, we do have a fully zoned, ready-to-go site we intend to do as a rental. That certainly caused us to pause taking that out. As much of an impact as the interest rates, the cost escalation, increase in development charges, even for a rental. I mean, those are things that really put a lot of challenge on any development right now, any construction. Certainly glad we don't have any condo sites that are ready to take out to market right now. I think anyone who can wait is waiting. It's, to Maurice's point, pre-con sales are really tough to do right now, mainly because people are waiting and seeing. If you're looking at mortgages and all sorts of stuff, like those rate increases have a huge impact. So I think we expect it to turn around. I think we've always been planning for the rates to be higher and longer for longer than anyone wants. But I certainly expect the market to change just because there's such a pent-up demand. But right now, it certainly is a tough time if you're trying to launch a project.
Thank you.
Yeah, I'll just add to that. I think that launching projects is important, but perhaps what has a more immediate effect is actually the projects that are being completed, the projects that are closing, the projects that had, hundreds of units, thousands of units out there, that had deposits of anywhere, typically about 15% deposits from purchase date. About 80% of the market is an investor market, perhaps more. And, you'd think that the rates having climbed as fast and aggressively as they have would have had an impact on the closings of those units. So all the condos that are being completed today, and as I mentioned through my previous firm at Collective, we actually have in the last 12 months completed 3 towers, and another 2 are coming in the next 6 months. And what I've seen is everybody's still closing on their units. So what does that mean? That means everybody's still getting a mortgage. A lot of sale assignments are happening. So people that bought units often buy the units with a right for a free assignment. So they assign the units for a little bit of a increase in the value of the unit. But it isn't 1990 all over again. Could it be? I don't know. I don't think so. But we're still seeing a strong, generally, I like to call it an equilibrium. You know, the value maintains, the ability to carry the unit maintains. It's certainly not an end user market where the end user can be the owner. But the rent that the end user pays still largely carries the cost of, mortgaging your unit, even with the higher interest rate environment.
I would say, so I agree, and I think the saving grace there is these projects have been under construction for 3 or 4 years. So when they bought, that purchase price might have been $900, $1,000 a square foot,
Yeah.
at $1,100. So the market now, if it's $1,600, that's I think what's giving people a lot of confidence to still close. If it was a $1,700 purchase price and they had to close today, that might be something where people are maybe more open to walking away from their deposit. But to Maurice's point, I think from what we're hearing and seeing, most people are still closing. And again, I think the big saving grace there is still a pretty big discount to today's rates,
Yeah.
in terms of the purchase price.
Great. Jeff, you mentioned land buying decisions. Can you speak more about how land buying decisions are made and how the decision is made whether to develop on land versus buy and hold?
Well, again, I think for us, we're in a fortunate position. We're not one of the larger, massive private equity funds or a publicly traded vehicle. So we can take a long time when we do our assemblies. We have piece of land, piece of dirt we've owned for, a decade or more, and they're still, 5 to 10 years out. So for us, that's how we view the risk-reward calculation. So we'll make early bets, which people view as quite risky in terms of the neighborhoods that we're going into at that time. But for us, it allows, so similar to Maurice's story in his Dundas site, it allows us to accrue a lot of land value when you get to the more risky part of development, which is the build. So we're a group that we're not building fully entitled sites, and we have an engine that delivers and builds buildings. We'll partner on that side. So for us, land, we take a long-term view. We like to see stuff that hasn't been built out yet, right? So, our site at the Lower Junction, so Perth and Sterling and Bloor, it's a good example, right? It was an industrial brownfield site, but with the transit that we saw coming there, it became obvious that there's a huge potential here to find a better use for that. Same thing with our waterfront site. So we do a lot of brownfield, a lot of industrial conversion, or stuff at Weston where we just see a pocket where it has been it's been challenged, and something happens, like the introduction of the UP Express, which for us, we still think is one of the most underutilized, amazing transit systems we have in the city. It's there today. It's quite convenient if you're on that. You can be outside the downtown. So, I think Marie said there's Union, there's Bloor Lansdowne, there's Pearson, but there's also Weston. So there's those kind of 4 stops. I believe they're going to also introduce one at Eglinton. So when we look at land, for us, I think taking a step back, a zero interest rate environment wreaked havoc on not just real estate. I think it's all asset classes and industries. So I think, it seemed easier than it probably was, right, to make stuff work. I think now people are getting back to fundamentals, right? So price of entry, location, those are things we've always kind of focused on. I think a lot of projects that 3 years ago put us, or 2.5 years ago put their submissions in, no longer work today. I think we're seeing a lot of that. So it's of no fault of anyone. Who was going to predict that cost escalations that we saw, charges, interest rates. So it's not an easy business. It's quite challenging, and so for us on our land side, we take a long-term view to de-risk that.
Maurice, do you have any comments?
No, I think we operate differently. We too are not a large private equity funded kind of development operation or one of these guys with these giant machines that you got to keep feeding. We're a very young and nimble company. Our model right now is to partner with landowners. And our model is a little bit different than Jeff's in that we try to go as fast as we possibly can. That we are sort of more of a site-specific partnership, and our partnerships are structured in a way such that, you know, the landowners are realizing the entire land value lift through the development process, and we are just stewards of that, and participating, of course, in some of the upside. But once the development comes to fruition, that's where we equalize with equity and land equity, cash equity and land equity, and move forward through the process. So I think that might be a little convoluted, but I think, Jeff, you mentioned earlier that, you know, interest rates are having an impact on purchasing decisions, and it certainly has, and we're seeing in the data the number of applications decreasing. I think over the last 20 years I've been in the industry, I've seen, every year be a new year of records, right? New number of units sold, a new number of units applied for, a new number of projects. And this was the first time we actually saw a decline in the 20 years I've been in the industry. And that to me is a very interesting observation. Could it tell us that we're going to be trending downwards? I don't think so. I think the fundamentals are way too strong from a demand side. But we are doing, I guess, from an acquisition perspective, we are doing structured acquisitions where we're not looking at acquisition financing for any of our sites.
We talked about timing decisions, et cetera. And there are many decisions as developers you guys make when it comes to building a unit, from who you choose as your partners to the type of finishings you choose. Can you talk about the decision-making process for the major decisions in terms of heights versus density, in terms of square footage versus open areas, in terms of amenities versus finishings, et cetera? How are those decisions made? Who's involved? And if you could give any insight there, it would be nice. Let's start with Jeff.
Well, I mean, look, for the most part, the taller, more density, more efficiency, smaller units, to really grind that out. I would say, in our experience, we've built tall buildings. There certainly is a threshold where that return is greatly diminished. You can have a 36-story building be a lot more profitable than a 60-plus story building. I think it's just the complexity and the timelines to deliver that. So we do try and focus on what we call good density, but now, I mean, for instance, we have one mid-rise site, actually two. Those are very, very challenging to make work right now. I think more and more you need that density to make the projects work. I mean, we work a lot with, it's a mix. You bring in consultants, you bring in advisors on the sales and marketing side. It's an amazing market, Toronto, because it's quite unique in terms of the scale, how many condos we're building, how many condos we're selling. There's very few markets that understand this type of density and volume. So we certainly take a lot in from these people who are selling, a lot. But you got to balance that out with what their incentives are. So, velocity for a sales agency is really important. Can you do the big blowout sale in a couple of days? As a developer, we're always wondering, are we leaving something on the table there? And also building better products. So, would it be a good building to just have 500 bachelors? No. Would that make the pro forma on paper work better? Yeah, of course, but there is a balance, and there's also guidelines for that. But to be honest, it's a really tough balance on, and I give Maurice and For a lot of credit on the design. we've taken big bets as well, like with the L Tower and challenging architecture. I challenge all of the developers to do a better job on design. I think you can see any building in Toronto and be like, that's a Toronto building with the podium and tower. It's so common. But it's this tough tension, right, between what you'd love to be able to do and aspire to do, both in terms of amenities and architecture and suites and everything like that. And just, Maurice said it, you need financing. And so you need to show a certain amount of profit, and that drives a lot of the decisions, unfortunately. So it's certainly not easy. And I give a lot of credit to people who take big initiatives and take big moves, because there's a lot of risk involved in this business. And it's, I think it's always exciting when people are challenging each other to do better.
Yeah, and I think when you care about something just as much as when you care about somebody, you're making decisions that are long-term decisions. And certainly profitability is an underlying factor. But I think that there's a lot more to it. You ask who is making the decisions and what are we considering. At the end of the day, as for me, as the president of a company, I'm making the decisions. And it's not easy to say that, because I'm making decisions on behalf of a lot of different stakeholders, not just financially, but in terms of the type of community we're building, the type of structure we're building, the type of energy consuming element that we're building, right? That's something we haven't talked a lot about, but I've completed, in the last 7 years, I've completed 9 geothermal towers, geothermal heating and cooling towers. Everything in my pipeline has a geothermal system in it. A project like that, maybe that's too complex, but a project like that, I think we have, to use round numbers, 700,000 square feet of density, 1,000 units, call it. To build a geothermal field here is sinking $6-7 million in the ground. And I have to ensure that the financial performance of the project on the development cycle, never mind on the operation side, nets even to what an investor would see if they were to invest with a guy building another 3-tower site without a geothermal borehole field. So who makes a decision to do that? I do. I must be fucking crazy to do it, to be honest. But we do it. How do we do it? We finance the borehole field in some cases. In some cases, if it's a rental property, the ultimate owner will look at that investment, because we know that the operational expenses are considerably lower. But a project like this, we're reducing 70+% of the carbon emissions that we would otherwise emit by building to the Toronto Green Standards, which are the minimum requirements today. We are saving somewhere in the 150 million liter of water per year realm on a project like this. And we know with the rising utility costs, it'll be cheaper to operate this building for our end users, for our property managers, at all levels. And the repair and maintenance budget is considerably lower because I don't have chillers and boilers and this entire plant to take care of. How do we make that decision? Well, I guess you rely upon a lot of experts. You have to ask a lot of questions. You have to really dig deep to figure out how to make things work. At the end of the day, it's an idea. We all know we can build, the way we build today. Podium, tower, spandrel glass, held together with caulking, and there we go. Two-pipe fan coil system, it's X number of dollars per unit. The average unit size at 625 versus 623 square. These are all decisions. They're huge decisions. They're decisions that are influenced, I think, by the context of a specific submarket. You talked about the UrbanToronto sort of 800-meter radius report. We look at that stuff. What is the competition doing? What has this specific submarket established as, the minimum thresholds? And then we have to ask ourselves, do we want to do better? And if so, how? And, who do we involve in that process? I think that we are becoming a lot more sophisticated as a development community, and I think that when I entered the industry, I would have said the opposite. I would have said we're a bunch of cowboys making very big bets. That's not the case today. I think that Toronto's development community is becoming more and more sophisticated. And again, to continue to plug Urban Toronto here, who's sponsoring the event, I mean, having data like that at our fingertips is so important. And hats off to what you're doing, Ash, with the entire team.
Thank you very much. So just to repeat the question for the camera here, the question is: do you, for your own projects, do you source the construction management internally, or do you bring in somebody from the outside, like a PCL? Start with Jeff.
So for us, we have internal construction leadership. So what I mean by that is contract negotiation, being very intimately involved in the construction drawings. We'll partner or bring in a construction manager on the actual delivery. That's a very human resource intensive part of the business. It's not something we particularly want to focus on. We like to focus on what we're good at. You're seeing a lot more developers start bringing that in-house. I think it's interesting. It's certainly not easy. So we'll look to bring in partners on that.
Yeah. Yeah, so again, for us brand new, we're not building anything actively. We're just zoning stuff. I have worked in both capacities, hiring third-party construction managers, and most recently at Collective, in the pipeline we had there, I built an in-house team. I see construction management as three things. You're managing your consultants, you're managing your trades, and you're managing the people managing the project, right? So project management and site management stuff. And so all things being equal, trades, you could be ambivalent on whether it's a third party or an in-house structure, and same with consultants. But I think the people is the biggest risk factor. I did have, without naming any names, an experience where with a third-party CM, this is many years ago, in a 3-year period of building out a tower, I had 5 project managers. And that's the construction industry today, right? People jump ship. People get offered an extra 10 grand, 20 grand, and why wouldn't you take it? What happens, though, as an owner, is that all of the project memory is gone. And so, exactly. And so for me, that was one of the biggest motivators to build an in-house construction management team, because then I could use a lot of, I'll say, the fee value internally to motivate and retain talent.
So again, just to summarize the question for the camera, the question is about the Toronto green standards. The new green standards are coming in a couple of years. How is that affecting your decisions today for your pipeline in the future?
Yeah, so this will be, I think, version 5. So with each version, the bar's been raised. But I think that timing of an SPA submission is what drives which version of the green standards you have to adhere to. And so that is, I think, pretty straightforward underwriting. You know what you have to design. It won't change, is I guess what I'm trying to say. Historically, my projects have not been Tier 1 standards, but rather Tier 2 standards. So again, it's what is that thought process in perhaps a more enhanced building system, and that's just decision-making and leadership, I'll call it, in making the choices for building buildings that we know, that we know the technology is there. We know that it works. Now, I think our role as developers is solve the equation for it, to be feasible. But yeah, the new green standards are a problem for a lot of the industry. You're right. The industry is a fairly standardized industry where I don't know the stats, but a substantial amount of what we're building is window wall. Window wall will, I wouldn't necessarily say won't work anymore, but it will have to be enhanced. We're going to have to see just a more robust frame with a more, perhaps the type of glass we use or the type of, I don't know exactly, but it's fairly predictive. Energy modeling is a part of every building application that we do. So we know what standards we're supposed to meet.
I think it's pretty early, like a lot of our architects and consultants we're talking to, everyone's trying to figure out how we make that work. I think it's gonna be a big problem. Like, I think there's an easy solution where you do triple pane and that sort of stuff, but then we're raising costs again. And again, it's the right thing to do, but then there's this balancing of how do you make that work and how does that not just get continued to pass on to the buyer. So similarly, we're introducing geothermal in a bunch of our projects, but I think a lot of people are sitting there going, okay, how are we going to make this work with our designs? I don't think it's straightforward. It's going to, and the buyer's going to have to adjust their expectations because, floor to ceiling, window, like it's tough to make that work unless you're going to really invest in an expensive product to meet those standards on the window side.
So the question is this project truly 22 car parking on Elm Street?
Zero. Yeah. No. I think that if you live on Elm Street, you don't use a car. Actually, it's about 10%. But I think that what we're going to strive to do is instead of sell those 22 or 26 stalls that we have today, because I think we resubmitted last week, we should be using those for car share. So if we have, a couple or few hundred residents in the building, if you live at Yonge and Dundas, you don't need a car. And the odd time you do, there should be one available for you. I have 2 levels underground. One will be commercial, more like a restaurant, like a speakeasy, maybe a high-end sushi joint. That's the vision today. And below that, there is 1 level of automated car park. So it's a postage stamp of a site. So the car goes into an elevator and then it goes into a system that shuffles the cars around. But yeah, I'm hoping that most of those will be just car share spots and perhaps some visitor spots, so that street parking isn't an issue.
I mean, you're now ballpark, I guess, $150K a spot. Very hard to monetize in our market. We still have spots at some of our stuff that's unsold. So, it's a challenge.
Great. And with that, thank you everybody for joining us today. And again, if everybody needs the slides, thank you.